Good morning from Julius Baer. Today is Monday, the 9th of March. My name is Bopp, and this is Julius Baer's Moving Markets podcast. More than a week has passed now since the war in Iran started, and what a week that was. In the latest View Beyond podcast, which was published over the weekend, Anderko Lehmann talks to Norbert Rücker, Head of Economics and Next Generation Research, and Yves Kleng, Head of Client Coverage and Advisory, about the impact of the war on oil and gas prices, the scenarios investors should consider, and how clients are responding to elevated volatility. It's available on this channel, Moving Markets, and it's called The View Beyond: How Are Financial Markets Reacting to the Strike on Iran? And reactions continue to be strong this morning, so I'll be talking first of all to Bernadette Anderko about the latest market news. And then we have a special guest on the show today, Richard Tang, our head of research in Hong Kong, will share his insights on the Asian markets. And then, of course, I'm looking forward to speaking to our head of technical analysis, Mensur Pocinci, for his Monday update from the technical side. So let's get started with the news roundup. Good morning, Bernadette.
Good morning, Jan.
I think we need to start today's podcast with the latest news out of Iran, don't we?
Yes, well, the big news this morning is obviously that Iran has announced that its new leader will be Mojtaba Khamanei. He's the son of the previous leader. And importantly, he is the man that President Trump had said would be unacceptable in the post. The immediate market reaction to this has been a 25% increase in the price of oil. I think the highest we saw on Brent crude so far today was nearly $119.50 per barrel, but things moving very quickly, Jan. Meanwhile, this has been accompanied by a fall in share futures in Asia amid fears of rising living costs. The US dollar, embracing its safe haven status, has risen sharply against the euro and the yen. So major Middle Eastern oil producers, including Kuwait, Iran and the United Arab Emirates, cut oil production following the closure of the Strait of Hormuz. The Financial Times is reporting this morning that 3 of the G7 countries, including the US, have so far expressed support for the possible release of petroleum from reserves which are coordinated by the International Energy Agency. And the ministers and Faith Birol, who is the IEA's executive director, are apparently scheduled to have a call at 8:30 a.m. New York time to discuss the impact of the Iran war. And a reminder for listeners, these reserves are designed to allow big oil-consuming countries to respond to significant energy shocks. Meanwhile, the FT reports China, India, Japan, Germany, Italy, Spain and South Korea are amongst the biggest importers of crude, which obviously leaves them heavily exposed to price shocks. However, China, which is not a full IEA member, also has its own vast oil reserves, and it's built these up over the last 12 months.
Okay, let's take a look at the stock markets then. I think talking about European and US market closes on Friday is now just old news, given what has happened over the last 24 hours. So let's focus on Asia market session. What happened here?
Yeah, so I feel like it's last Thursday all over again. South Korea's Kospi has triggered its second circuit breaker in 4 sessions this morning, at one point down 8%, and that caused a 20-minute suspension in trading. And again, like last week when we saw this circuit breaker triggered, Samsung Electronics and SK Hynix have taken large hits, falling between 10 and 12%. The Kospi has recovered a bit since then, though, Jan. I think it was last off around 6% when I looked. And the story is similar across the region, but to varying extents. So again, last time I looked, because things are moving very quickly, Japan's Nikkei was down around 5%. The Topix was down around 3.5%. The Hang Seng not suffering as much, down only around 1.6%. And the CSI 300 actually off less than 1%. All markets seem to be off their lows of the session on the back of this potential G7 oil release, though.
You mentioned the dollar rising earlier. What about other traditional safe havens? How are they reacting?
Yeah, well, US Treasuries have actually sold off. I think this is mainly because of concerns over quickening inflation. So I think the benchmark US 10-year yields were around 4.19 last I looked. But the story's the same elsewhere. Australia's 3-year government bond yield surged to its highest level since 2011 overnight. German bond futures have slumped to almost a 15-year low. And Japan's government bond prices have also fallen, with yields on the 30-year and 40-year bonds raising around 11 basis points in the session. And gold, well, that's trading below $5,100 an ounce, and that's pressured also by a stronger US dollar. And again, these concerns over interest rates not dropping. Markets now, of course, believing that the war might mean that the Federal Reserve will have to leave interest rates unchanged for longer.
Apart from following the latest developments in the Middle East, is there anything specific investors should be watching out for today?
Well, I think the main focus will be this G7 meeting in the US later today. We've also got US February CPI report coming out midweek. We'll have the January PCE index out on Friday. That's obviously closely watched by the Fed. Inflation readers from China offering insight into demand conditions in the world's second largest economy. We had consumer inflation reported there earlier today that showed the biggest jump in more than 3 years, while deflation in factory gate prices moderated. Consumer price index rose 1.3% in February in China from a year earlier. We've also got European industrial production and price indicators out this week. And in Asia, again, further activity data from Japan, which will remain closely watched. Meanwhile, looking ahead to the equity markets in Europe and the US today, I'm afraid those screens are in the red, Jan. So good luck, everyone.
Yeah, it looks like a rough start to the week. Thank you very much, Bernadette, for the roundup today.
Thanks for having me, Jan.
And now, Richard, good morning to you as well. Great to have you on the show today.
Good morning, Jan. How are you?
Very good, thank you. Now, Richard, it's been a volatile week already. Asian markets also had a few tough days. Among all these, the Korean market has fallen the most. We talked about it with Bernadette. The Kospi was down around 20% in just a few days of trading. Japan also seems to be catching down. How should we interpret all these moves?
Well, the first thing, as Bernadette already mentioned, as we speak, the headline news about G7 releasing their oil reserves definitely helped Asian markets pare some losses. So hopefully the more satisfying and better sentiment will feed through into Europe and US as well. In Asia specifically, I would mention that at least for now, the positioning driver is more powerful than the fundamental driver driving the price moves. Obviously, from a fundamental perspective, most of the Asian markets are net oil importers, and that's particularly true for the North Asian markets. But if you look at what really moves more and what less, it's really the year-to-date winners fall much more than the year-to-date laggers. So, for example, even with the almost 20% down in Kospi, the Kospi index year to date is still up 25%. Japan a little bit less, up 5% year to date after the fall. But I think what is worth mentioning is that China this week has been much calmer, and I think that's because particularly Hong Kong has been underperformer in the Asian market year to date. So I think that's a positioning argument. If you look at the implied volatility from the options market, we can see that the vol for Kospi as well as Nikkei had totally spiked. And for Hang Seng Index, it's much calmer. So again, I pointing to my argument that right now, at this moment, is really about positioning driving all the moves.
Interesting. Now, if we look at last week alone, the Hong Kong and Asia market seems to be falling less. Is it because there was good news from the National People's Congress? How do we see China from here?
Yeah, and as I said, we think the main reason was simply that it's been an underperformer year to date. If you ask me whether the National People's Congress has been good news, I would say the event is largely in line. I think some of the investors might be a little bit disappointed that the growth target was taken down to 4.5 to 5% growth for the GDP in China. But I would say it's within expectations. In fact, our economists have already shared that expectation. In the event, there have been several topics being emphasized, including bringing back inflation or i.e. reflation. They still emphasize the importance of building core technologies. And I think encouragingly, they also mentioned that they need to improve income for people. But overall, I would say that that's a neutral event for market. I think there might be some more detailed industry policies, for example, regarding tech development that would follow after the National People's Congress. And those details could help sentiment. But I think the precondition is obviously that the oil and the gold market has to stabilize first.
All right. And what are your expectations for Asian markets in general over the next, say, few days or even weeks?
Yeah, I think it's fair to say that the markets are super hard to predict if we focus on only the next couple of days. I would expect there would be both sharp sell-offs and short squeeze at the same time, so it will be fairly volatile. But if we look at the fundamentals of those markets that we just discussed, like Korea, Japan, and China, they're still largely the same. So bearing a sharp deterioration in the economy, which is obviously not our base case, I would argue that Korea will continue to see a shortage of memory because the demand is still intact. Supply has been very, very tight. I think Japan will still be in favor by the market because of market's hope on Sinonomics. And also, more importantly, China, even though the Chinese tech stocks have been sold off because of the global AI disruption trade, I think we would definitely emphasize that the majority of stocks in China tech, they still have the business models being intact. And I would actually argue some of those tech stocks, particularly the larger ones, start to see some value re-emerging.
Interesting. Thank you very much, Richard, for making the time to join us on the show today.
Thank you, Jan.
Now, Mensur, the big story today is oil. Oil prices have jumped dramatically over the past hours. What is your technical view of oil prices and energy stocks?
Yes, good morning, Jan. So first of all, on oil prices, we see that they have seen now 2 weeks of gaps. So it was always on Monday when prices gapped higher. And in technical analysis, basically, you believe that most of these gaps are closed. So we see here, first of all, an extreme situation in momentum, so an extreme uptrend. And secondly, we see here as well divergences from the contract. So we see that the front contracts are rising a lot more than the, let's say, the 12-month contracts in oil. So usually this is a good sign of stress in the market and usually of a short-term top. So we would expect that oil prices come back. And then the next question, of course, will be if a new long-term uptrend in oil prices can start. The picture is quite different for oil and gas stocks. So they have started to outperform already in December. And there basically the uptrend is quite stable. So there we would expect that the outperformance against the overall equity market should resume from this point going forward, even if oil prices stabilize or come down slightly from current levels.
And equity markets in general, I mean, they have seen dramatic losses last week. Is the medium-term uptrend ending for equities now?
Yes, it's always tricky here to call a top in equity markets. So when we look here at what are the tools from technical analysis we can take a look at, so usually it's the 200-day moving average. And when we look here at the US, we see that the S&P 500 is still above its 200-day moving average. So that level is currently at 6,582. So quite some levels below the close on Friday. So usually this is a good signal. And when we look at other markets, we see that some markets have already broken below this level. So some European markets have already broken below their 200-day moving average.
Okay, Mensur, how does a topping process usually play out?
Yes, this is the tricky part. Basically, it's not an event, so it's more a process. So what does this mean for investors? It basically means that over the next 1 or 2 weeks, we have to watch closely how prices behave around this 200-day moving average. So will these prices be enough to attract buyers, or will this only be an opportunity to sell? And I think a good example here is the Hang Seng Index, so stocks in Hong Kong. The reason for this is that this index already is trading around its 200-day moving average for 3 consecutive days now. And so it will be important to see if this indicator maybe is a leading indicator to see if there is more demand around this level and prices can recover. So this means for investors that over the next 1 or 2 weeks, we are watching closely the behavior of prices and demand for equities around the 200-day moving average. For the time being, we would still give the equity bull market the benefit of doubt. And as said, it's a process, so it's not an event. So we're watching here closely the markets unfold in the next 1 or 2 weeks.
I will do that too. Great. Thanks very much, Mensur. Really good to hear your latest thoughts, as always.
Thank you, Jan.
And that is all for today. A big thank you to Bernadette, Richard, and Mensur for sharing their perspectives. And thank you all for tuning in. If you enjoyed today's show, don't forget to subscribe if you haven't already. And please also leave us a review on whichever platform you like to listen on. And do join us again on Tuesday when Bernadette will be your host with a fresh lineup of experts analyzing what is moving markets. Until then, good luck today and goodbye for now.
The information and opinions expressed in this podcast constitute marketing material and are not the result of independent financial or investment research. Please refer to www.juliusbaer.com/legal/podcasts for further other important legal information.